currencies are very, very important, and we have had a significant amount of volatility in the currency over the past few years. As you know, it had been a one-way trade for a number of years, whereby the US dollar was getting stronger. The euro, emerging market currencies, RMB were expected to depreciate, and that actually led to a significant amount of assets flowing into US dollar categories over the past few years. And the dollar peaked basically in March of this year. Usually when there's a significant shock or risk-off event, the dollar strengthens significantly against other currencies. And what we have seen since then is that actually because of the unprecedented QE and monetary easing that the US has done, as well as the fact that the US is coming out of the COVID later than China versus some other parts of the world, we've actually seen the US dollar come off pretty sharply from, DXY peaked at 103 and is at 93 at the moment. And that may continue as the rest of the world continues to strengthen, and the yield differential and growth differential advantages that the US had previously start to diminish to some extent. So we think that probably over the next couple of years, as the global economy starts to further normalize and go into an expansionary phase, the US dollar does have room to weaken a bit further, and that gives a bit less pressure to the renminbi versus what we had seen in the previous years. That actually sets up for a virtuous feedback loop for Chinese assets. So for example, if people see that the interest rate in China is meaningfully higher versus the US, the yield differential is basically at its peak level, plus the currency doesn't have nearly as much pressure as before. We're seeing a lot of currency inflow and FX inflow into China's bond market, into China's equity market. These are precisely the type of effects that the policymakers are looking to see and try to maintain for some period of time. So I think net, it is a positive asset allocation driver for emerging market assets and not just US assets, which has been the main outperformer of global assets in the past couple of years.
When you consider the central bank differential in place, though, I mean, the realization that data is going in many ways from strength to strength in China, does this support the conclusion that you won't get as much in the way coming from the PBOC and additional stimulus, and then you're back in this good economic news means bad news for the market paradigm, or not this time around?
I think not so much this time around, because people have realized over time that more monetary easing in China is not necessarily the best, given the extent of the leverage that has built up over the years. And so people see that better fundamental and less need for monetary easing is actually probably a bit better, right? And obviously, very significant extent of monetary easing will put more pressure on the currency as well. So people see it as a better balance, I think, versus what we had previously. And that policy inflection has clearly already come in the summer. You can see it in the Politburo notes. You can see it in the policymakers' comments. You can see it in the way that the China 10-year has moved about above 3% from a bottom of 2.4%. So I think all of these things are showing you that if necessary, they can ease, but at the moment, it's not necessary to ease. So they would actually rather preserve more tools and ammunition for the next potential risk. And so long as that doesn't arrive, I think they're perfectly happy to keep policies, a little bit more normalized. And I think the market appreciates that as well.